welcome to Inside ETFs. I'm Elena Casas. Today we're looking at cannabis ETFs with Bob Jenkins, the global head of LIPA research at LSEG. Owners of cannabis ETFs could be forgiven for thinking their money has gone up in smoke. Like other highly speculative thematic ETFs, they've taken a beating this year. Their poor performance has been compounded by the failure among congressional lawmakers to agree on legalizing cannabis at the federal level, leaving the industry unable to access funding. Investors in cannabis ETFs must navigate a haze of products. Here are three for comparison. The largest is AdvisorShares Pure US Cannabis ETF, which holds mostly cash or bonds, followed by a handful of multi-state operators such as Trulieve. Others, such as Alternative Harvest, hold well-established Canadian operators like Canopy Growth and Tilray, while a third set hold companies with even more peripheral players, such as drinks and tobacco companies that may benefit from legalization. So does the fund industry need to clear the air? Let's ask LSEG's Bob Jenkins. Bob, hi, thanks for joining us. Now, I know in a note you compared cannabis ETF's flavour of the month to the tech bubble. Why make that comparison?
You know what you see with a lot of these thematic ETFs, they come off the back of what is a very emerging trend that's in the news or what have you. And certainly what we see, and we not just in cannabis, but if you look at what crypto and even COVID-related products such as work from home funds came out, Meta certainly. So this happens quite a bit. And they basically, the fund companies flock to this trend. They build product pretty rapidly and investors pile into it. And you see that they all have a very similar type of trajectory where they rise up relatively quickly. And then, the realities of the business start to come into play and they typically fall down. So I think a lot of these products should come with a warning label.
The cannabis space, though, is unique, obviously, because of the regulatory problems. But assuming cannabis will eventually be legalised at the federal level, shouldn't this be time to buy?
Cannabis stocks are being ascribed essentially valuation models akin to large tech growth companies or large cap growth companies. And this is not the case. And if you think about cannabis in general, it's an industry with very low barriers to entry. People have been growing this stuff for years, right? There's also not a lot of IP necessarily in this space either. And so what you really have is an industry that's really rife for a lot of large players to come in, create economies of scale, and then drive the competition, particularly the smaller players, out. In the U.S. now, again, as you mentioned, they don't have legal statuses yet, so that limits kind of the cross-state efficiencies that you could attain if you were able to, and very importantly, it limits their access to capital and business lending. And so, therefore, again, all the smaller players kind of get squeezed out. And at the end of the day, I think what we have to understand is this is essentially a commodity agricultural product, and it's going to have to start to live within those valuation expectations. And I think broadly, that's where it's going to go. That's where the story is going to go.
Let's drill down then, Bob, into the types of ETFs you can actually buy in this space in the US at the moment. Do they actually do what they say on the tin? Because some of the so-called pure play ETFs aren't very pure play at all, are they?
No, I when looking across both the U.S. and Canada, I found about a dozen products in each country. And to the point, and you made this point earlier, the two largest product lines, if you will, have that two-part, if you will, structure where they have a cross-regional product. Again, this across U.S. and Canada, and a U.S.-based product. And in both cases, the cross-regional product invests heavily in the U.S.-based product, which happens to be heavily invested in treasuries. So yes, that is not what one would think. But of course, objective language always opens a door for a variety of creative investments. And that is the case where derivatives and so forth and other products that have similar characteristics are allowed to be invested in. Again, arguably, treasuries aren't that. But on the flip side, these are all active products too. And you really might want to give credit to the fact that these managers are trying to steer their investors and shareholders away from what's going on in the industry right now by putting them in a safer place until the industry sorts out its valuation issues.
I know you've expressed some doubts already, Bob, but if you were trying to get into the cannabis space, how should one do it?
Really, unfortunately, right now, though, I think the asset managers are stressed for good choices of what to invest in, because a lot of these companies are also still finding their way. So you really need to understand. For me, I think I would be holding back a little bit as an investor and waiting for this industry to sort itself out, quite frankly, Again, not just in terms of the valuation models, but how the businesses are actually run. Because I think that there was a little bit of hubris in terms of how they were spending and building the businesses and growing into a variety of areas that weren't necessarily profitable. I personally would be in more of a wait and see mode and find those managers who can find the value and the future growth.
Well, thanks so much for that insight, Bob Jenkins, Global Head of Lipper Research at LSEG. And that's your look at cannabis ETFs. I'm Elena Casas, and this is Reuters.